Why buyers and sellers disagree? Let's talk markets. It's a jungle out there. We've got buyers, we've got sellers, and they're all convinced they're on the right side of the deal. That's the paradox, right? For every winner, there's gotta be a loser. Think of it like a tug of war. Bulls pulling for prices to go up, bears digging in their heels, betting on a downturn. Both sides can't be right, can they? That's where it gets interesting. Each side looks at the same information but sees something different. The bulls? They see opportunity, growth potential, and a chance to make a buck. The bears? They see danger, overvaluation, and a bubble about to burst. This constant push and pull, this battle of perspectives, is what makes the market tick. It's why we have volatility, uncertainty, and frankly, why we all tune in every day. Because in the end, someone's prediction is going to be right. The question is, whose? Now, let's talk about the players in this game. Traders, investors, they're all trying to predict the future. They're poring over charts, crunching numbers, and trying to get an edge. Why? Because in this world, information is power. A correct prediction can be the difference between a huge win and a devastating loss. But here's the catch. The future is, well, unpredictable. Every trade is a gamble, a calculated risk. You're putting your money where your mouth is, betting on your ability to read the market better than the next guy. It's not just about being right, though. It's about managing risk. Knowing when to hold them, knowing when to fold them. Because even the best predictions can be wrong, and you gotta be prepared for that gut punch. History is a funny thing. It repeats itself, but never quite the same way. Looking back, we can see patterns, cycles, and trends. We can learn from the mistakes of the past, from the booms and busts that have shaped our financial landscape. Remember the South Sea bubble? Tulip mania? These historical meltdowns show us the dangers of speculation, of getting caught up in the hype. They remind us that markets can be irrational, driven by fear and greed. But history also shows us the power of resilience. Markets recover, economies adapt, and new opportunities emerge. It's a constant cycle of growth and correction, of exuberance and caution. The key takeaway? Don't bet the farm on any single prediction. The past can guide us, but it can't predict the future with certainty. Section 4. Wrong Way on Wall Street. Famous financial flops. Let's face it, everyone loves a good train wreck. And in the financial world, there's no shortage of spectacular crashes. Remember when the dot-com bubble burst? Fortunes were lost overnight. Or how about the 2008 financial crisis? That was a doozy. Experts missed the warning signs, and the whole system nearly collapsed. It was a harsh reminder that even the smartest people in the room can get it wrong. These high-profile failures highlight the difficulty of making accurate predictions. They show us that even with the best data and sophisticated models, the future remains stubbornly opaque. The lesson here is clear. Humility is key. No one has a crystal ball, and anyone who claims to have all the answers is probably selling something. Section 5. Modern Defenses. Managing Risk in a Volatile World. So, how do we navigate this minefield of uncertainty? Enter risk management. It's the art of protecting yourself from the downside, of minimizing losses when things inevitably go south. We've got all sorts of tools now: diversification, hedging, stop-loss orders. These are like shock absorbers for your portfolio, designed to cushion the blow when the market throws a curveball. But even with these defenses, there are no guarantees. Risk management can mitigate losses, but it can't eliminate them entirely. The market is a wild beast, and sometimes the best defense is simply to ride out the storm. Section 6. Outsmarting the odds. When predictions hit the mark. Now, it's not all doom and gloom. For every prediction that misses the mark, there are those who get it right. Look at Warren Buffett. The Oracle of Omaha, they call him. He's built an empire by making smart, long-term bets. Buffett's success isn't about magic or luck. It's about discipline, patience, and a deep understanding of value. He's not trying to time the market or chase the latest fad. He's looking for solid companies with strong fundamentals. So, yes, It is possible to beat the odds, to make predictions that stand the test of time, but it requires a rare combination of skill, temperament, and a bit of luck. Section 7. The human factor, psychology, risk, and the allure of the gamble. Let's be honest, we're not always rational creatures. Our decisions are influenced by emotions, fear, greed, hope, and the herd instinct. And these emotions can cloud our judgment, leading us to make irrational choices. Think about it. We buy high when we're feeling optimistic, and we sell low when fear takes hold. We chase hot tips and ignore warning signs. We get caught up in the moment, forgetting the lessons of the past. This is the human element of finance. It's what makes the market so unpredictable, so fascinating, and so dangerous. Because in the end, it's not just about the numbers. It's about understanding ourselves, our biases, and our own capacity for risk.